You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu.
Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Retirement Friday. Today, we're going to talk about why I don't think you should change your investment strategy at retirement. And that is like a big belief, right? So you're about to retire or you retire today and boom, you have to go safer. Like good old rule of thumb, you take 100 minus your age. So 100 minus 65, boom, 35% stocks maximum. So that's like already the rule of thumb. But most people have this belief. We should go with something safer. We should go with less volatility. And ironically, a lot of like investors think that it also means going for a higher yield. Well, a higher yield is not necessarily safer. And especially if it doesn't increase the distribution, if the distribution doesn't increase, your portfolio is actually hurt by inflation every single year. So you're losing buying power. So it's like getting a reduced paycheck for retirement every single year. I don't think you want that, right? But why do we think we have to go safer? Well, it sells well, right? No one will go after you if you don't take much risk, right? People will get angry if they lose 10%, but if they don't see that they're losing money on opportunity costs or on weak interest yield, well, then they're not going to go after their advisor. So the advisor is just like playing safe, say, you know what, let's put everything at 3% and then call it a day. Ironically, it's never going to get you in trouble if you're an advisor, but I don't think you're doing your job. Actually, the Go Safer is built on two major myth, in my opinion, and we're going to cover that today. So we're going to cover those two myths, and then I'm going to tell you what I'm going to do at retirement. And I've been quite consistent with what I say. It's been 22 years now that I'm investing, and I have always been 100% in equities, like 100% in stocks. And then in 2010, so 15 years ago, I discovered dividend growth investing, and I never changed my strategy since then. So you can say that I just follow my rules all the time. Of course, there's a point of like adapting, but I'm very consistent. So I'm fairly confident that my perception of investing, if it hasn't changed in the past 22 years, not going to change in the next 22 years or when I will retire. So let's go back to the myth now. Myth number one, a lot of investors think that making a $50,000 mistakes at the age of 45 is okay, but not at the age of 65. So in other words, if you're losing $50,000 on your portfolio because the market is bad or you made a bad investment. Anyways, you lost $50,000 at the age of 45. Well, you still work, you still can add capital, and it's not that bad. You have plenty of time. So you have time and capital to add so you can recover from that loss. But not at 65. So let's take a look at this myth now. Of course, at 65, you're retired, so you cannot add that capital and you have less time, of course, because you're not 45 anymore. So imagine that you live up to 85, just to make round calculation. So imagine like the impact of like a $50,000 loss at the age of 45 at like 6.5% for the next 40 years. That's $620,000, $600K. So that's the impact. So you're telling me it's not that bad? Well, and you don't tell me that you can add capital because that was already part of your plan. You were supposed to add capital past the age of 45 to complete your retirement nest egg. So that's not changing anything of the fact that you lost $50,000 and you have time to recover. Well, not necessarily, right? So if you lose the same $50,000 at the age of 65, well, the impact at the age of 85, so in 20 years at the same rate of returns, is 176. So $600,000 mistakes or $200,000 mistakes roughly, well, that's a big difference. And then it makes even more difference when you don't have a plan. Because if you have a plan, you know that markets goes up and goes down. And you know that you will not have like an even 6.57% return year over year. Actually, just as an example, I bet you didn't plan that from 23 to 25. So from January 23 to January 25, the Canadian market was up 35%. The US market was up 58%. And if you, instead of invest in US dollars, you went from like a VFV, for example, that is not hedged for currency, that was up like almost 67% in 2 years. Kind of crazy, right? So double digit returns 2 years in a row. Did you factor that in your plan? Of course you didn't. So if you're down 10% the following year, well, then that's just bringing back the average at the right place. So you should not necessarily focus on going safer for that reason, because you will also have amazing years to protect or to compensate for the upcoming market drop. So speaking of returns, that leads us to myth number 2. It's safer to have like bonds and cash. I mean, it is less volatile for sure, but is it that safe? I don't know. Like the first question you should ask yourself is, can your retirement plan take it? Can you retire on a 3% return? And then you're going to say, oh, Mike, well, you're getting harsh with your returns. Right now, I can get like GICs, cash and bonds at like 4% easy. Well, when you plan your retirement, you don't plan for the next 2 years. You plan for 20, 30, 40 years. So I'm going to ask you again, what is the chance that your GIC ladder or your bond will average 4% for the next 30 years, not for the next 3 years or the past 3 years, next 30 years? Well, probably that you're going to get a lot closer to 3% than 4, right? I mean, if you look at the past 30 years, that's probably what you got, right? Maybe even less than 3%, I don't know. But I mean, just to show you. And now if you factor inflation and you factor taxes, if you have like part of your portfolio that is in non-registered assets and you have to pay tax on that interest income, well, now you're going to drop even more. Actually, you're going to like lose money every single year if you invest everything at 3% and you have an inflation that will go around 2, maybe a little bit more, and then you add taxes. Maybe you don't even protect your assets. So that's kind of risky for me, like a lot more than investing in a market. And on the other side, if you're like having a balanced portfolio, not to go into the extreme, so like roughly 50% bonds, 50% equities, well, then your return should be around 4.5 to 5%. That should be about the numbers that you use in your plan. And then you still have to factor inflation and taxes on top of that. So maybe it's going to work, but maybe not. And the best way to do it is to actually run a projection. If you stay with the strategy that you have, maybe it's like 80% in stocks, for example, or in my case, 100% in stocks, and then see how it goes. And then do the same projection, but reduce your returns to 4.5 and 5%, and then see if the plan still works. If it still works, well, that's perfect, because of course, I totally get that at retirement, you want to be safer in the sense that you don't want to go through a lot of volatility. You want to sleep well. You don't want to stress over your portfolio. So I totally get that. But just make sure that you run the numbers first, because maybe you cannot afford to, because that's a luxury. It's a luxury to not have fluctuation in your portfolio, right? But if you want to have return, or if you must generate returns to retire the way you want, well, then you'll have to accept some volatility. And speaking of accepting this and tweaking your portfolio and your entire retirement plan, I will have a super cool webinar next week about 6 retirement upgrades. So those are like for Canadians. We're going to talk about how you can build your plan, tweak it, stress test it for like market crashes, if you die earlier, all of those things at retirementloop.ca/webinar. So that's retirementloop.ca/webinar. We're going to cover 6 retirement upgrades. If you register, you're going to receive the replay for free. If you don't register, well, you're never going to hear about it again. So that's next Thursday, retirementloop.ca/webinar. So I'm going to end the show with what I will do. Well, what I will do is like super simple. I'm going to keep the same strategy, most importantly, because I'm super comfortable with it. I love my strategy. I sleep well with it, and I believe it's going to continue to work for the next 40, 50, 60 years, name it. So that's the key, sticking to your strategy for decades. And then you're going to say, but Mike, your portfolio's yield is not high enough, so it won't cover your retirement budget. Yeah, fair enough. So what I'm going to do if I have to sell shares when the market is down? Well, the famous cash wedge, right? I've been talking about having a cash reserve for many years now. So 3 years of cash reserve. So whenever the market is down, I will not even look at it. I will not even look at my portfolio. I will say, okay, that's down. I have cash. I'm just going to take the cash until, like, it's raining outside. You're going to Like, stay inside, open the fireplace, read a good book, and when it's going to be sunny outside, you're going to go outside and you're going to benefit from that, right? So I will sell shares when my portfolio is up and when the market is not doing well, and that happens like for a year, maybe for 2. So 3 years, like perfect cover here. I'm just going to use the cash wedge and it's going to be just fine. The whole point here is I don't want to depend on distributions and higher yield. I want to invest in robust companies because those companies, I know they will continue to thrive in the future. So I don't mind if there are like some market hiccups, and I will just go into the cash wedge in the meantime. So it's super simple, and it's great to keep it simple. Honestly, you have like so many things in your life to manage. There are like so much information that if you can keep something super simple, like having your portfolio that is 3 years of cash reserve plus whatever your strategy is, and then boom, rinse and repeat every single year, you're all set. So don't forget a webinar next week on Thursday, Retirement Loop. That's loop.ca/webinar. So retirementloop.ca/webinar. I'm going to see you there. And until next Monday, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.